Welcome back to Bazaar Morning Call. We have plenty of stocks to talk about today, actually. So let's get our entire research team on board. Marico is the first stock we're looking at. Mangalam is here to tell us how the numbers look. Mangalam, good morning.
Good morning. So for Marico, it looks like it's a mild beat on the revenues, and the EBITDA and the net profit have been above the poll. So, so far we've seen most of the FMCG companies report revenues which were slightly below expectations. That's not the case with Marico. If you look at the revenues, 2476 crores. The street was working with a number of 2465 crores. So a couple of crores higher than that. The EBITDA came in just shy of 500 crores. The street was working with a number of 485 odd crores. Margins coming in at 20.1% and the net profit being above expectations as well. Even the volume growth at 3% is at the higher end of expectations. The good part is that the management outlook is rather positive. They believe that revenue growth will move into positive trajectory in the second half of this year. The gross margin uptrend has been upgraded from around 150 to 200 basis points to 350 to 400 basis points. Even if they plow back some of those in ad spends, the EBITDA margins are likely to improve by about 200 basis points. That too is higher than their earlier estimate. And food and premium personal care, which has been the growth driver for the company, will grow to 20% of sales versus 15% of sales. So see some green on the stock, largely because a lot of the negatives have been priced in when the company reported their second quarter update already.
Okay, thanks a lot for that. Well, the other stock I'm looking at is TVS Motor. I'm going with green over there because the numbers were very good. In fact, it was a record high EBITDA as well as margins that the company delivered this time around. And the earnings were quite strong, largely in line with estimates. The EBITDA margins came in at 11.1%. If you remember, TVS for the last many years was struggling between 9 and 10% margins for the longest time. But this quarter, it's the highest ever quarterly operating EBITDA of 900 crores. That's largely because raw material costs have fallen and the product mix has improved for them. So just take a look at it. 90 basis points year-on-year improvement in margins for TVS Motor. Revenue growth in double digit, about 13% growth is what we saw. EBITDA went up by 22.2%, and this at a time when exports have still not recovered. So a lot of positive brokerage reports indicate that once the export piece starts recovering, then TVS Motor will, be a big beneficiary of the revival in the export market, and hence they're expecting better numbers. So I'm going with green over there.
Okay, all right, going with green for TVS Motors. But let's hop across to Vivek. He's here to tell us about GMR reports. Morning, Vivek.
Well, good morning. It's a strong operational performance. Operational metrics across all parameters have improved. However, the bottom line has been a loss. But still going with the green on this particular name. Revenues on a year-on-year basis higher by 30%, mainly on account of improved passenger activity. So total PAX traffic has actually improved by 25% on a year-on-year basis, coming in at 26.5 million passengers. Now, the EBITDA is up 55.2% on a year-on-year basis, and margins have expanded quite significantly. This time around, coming in at 35.2, more than a 500 basis points expansion. However, on the bottom line, due to increased debt and increased finance costs, the company reported a loss of 190 crore. A couple of important things that the company has said. Number one, there has been significant progress as far as the complete merger of the parent company is concerned, and there is a shareholder meeting kept on December 2nd. Along with that, the company has also said that it's looking to refinance the debt of GMR Airport. And lastly, the company has said that they will complete the ongoing expansion of Delhi and Hyderabad airports within FY24 itself.
All right, Vivek, thanks very much for that. Well, let's move on. There is DLF, which reported numbers. UPL came out of numbers, I think, during market hours, but there was a guidance bit, etc., and SRF as well. Sonal is here with views and sort of insights on all three. Sonal, hi, morning.
Good morning, Prashant. Let me start with DLF, where the numbers look good. In fact, they saw collections which came in at highest ever level at around 2359 crore rupees. Surplus cash flows were at the highest at 1,147 crore rupees. And this time around, company has turned net cash, which again is a big positive. They were net debt till last quarter at around 57 crore rupees. Residential sales, they are up 8.5% on a YOY and on a quarter-on-quarter basis as well. And company says they are on track to achieve their residential sales guidance of around 13,000 crore rupees in FY24. For SRF, there was a conference call yesterday where the company said that they are able to guide for a single-digit growth in their specialty chemicals business at a time when across the globe there is a guidance cut coming through. They are saying that although demand is subdued, there are no order cancellations. In their fluorochemicals business, they are expecting recovery in the second half in both domestic and international markets. However, packaging films business will continue to see some pressure, but technical textiles will be stable going forward. For UPL, the guidance cut was the big negative that we saw yesterday. But the company says they expect to deliver better profitability in second half versus first half. High cost inventory, higher liquidation and rebates to channel partners hit the contribution margin in UPL SaaS business for them this time around. But in the third quarter, El Nino will be a major monitorable across geographies for them as well. And they will reduce their capex as well by $50 million from its earlier capex guidance of $300 to $325 million. So across the board, we've seen guidance cuts for UPL, and the conference call also spoke about some of the issues that persist right now.
All right, thanks a lot, Sonal, for that. Well, Blue Star was the other good set of numbers that came through. Surbhi's tracking that. She's also looking at Butterfly Gandhimathi. Surbhi, hi, morning.
Good morning. So Blue Star, really strong set of numbers. The revenues were up 20%. The EBITDA was up 43%. The company saw margin expansion of 90 basis points. PAT was up 66%. Now, unitary products, which is 39% of their revenues, that is what drove the higher revenue growth. The revenue over there was up 39% and the profitability was up 90% on a year-on-year basis. So good set of numbers from Blue Star coming in. Butterfly Gandhimathi will be in focus, and that is because the public shareholders of Butterfly has rejected the proposed merger with Crompton. Now this means both Crompton and Butterfly will continue to operate as separate entities, and Butterfly will continue to remain Crompton's subsidiary. Crompton's management has said that development will not have any significant change in the growth strategy, and the companies will continue to operate as separate entities and work towards fulfilling the mutual strengths. So the initial tick on Butterfly could be red, but we expect the stock to recover from there.
Got it. All right. Thanks for that, Surbhi. Let's hop across to Abhishek. Abhishek, how was Spandana Sphoorty's numbers?
Well, it looks like the tenure of the book increased in Q2, and that's aided the AUM growth this time around. Asset quality has improved. Gross NP ratio is down to 1.4% versus 1.63% in the previous quarter. Looks like high write-offs have actually aided the asset quality this time around, given the fact that provisions are up massively on a YOY and sequential basis. So disbursements are up 81% YOY and about 51% quarter on quarter. Disbursal to AUM ratio that I calculate is around 37-38% versus around the 20% mark that was there same time last year quarter and even in the previous quarter as well. AUM growth of 69.2% YOY and about 10.5% sequentially. Net interest margin largely stable, just down by 10 basis point quarter on quarter. Yields have aided the net interest income this time around. Net interest income is up 87.5% YOY and about 24% sequentially. Other income was robust, up about 145% YOY and 96% quarter on quarter. As I said, it might have been high write-offs that aided the asset quality because provisions are up 264% YOY and about 261.5% sequentially. PAT grew by 135% YOY and about 4.5% sequentially. Back to you.
Okay, Abhishek, thanks a lot for that. Well, I'm looking at Vesuvius, and yet again, the last couple of quarters I've been mentioning this, that the numbers are a beat. And yet again, the numbers are a beat because they look very, very good. On the top line, there was a growth of close to around 17%, but the EBITDA growth, that was more than 60%, which takes the margins higher as well. And the key reason is gross margins have increased big time. If you look at it, it's gone to around 46%. So a better mix, lower cost, that's what helped the margins now move to around 20%. And that's the highest we've seen in many, many years. I think the last time we've seen margins like this, maybe it was in 2017, 2018. The profitability as well got a boost up because other income is higher. Remember, as a percentage of the total market capitalization, cash in books is around 600 crores, and that equates to nearly around 9 to around 10%. So the numbers look good. The stock has seen a big run already, but I expect the stock to open up well in the green on the back of these blockbuster numbers.
Okay, so a lot of good numbers is what we're looking at this morning, whether it's TVS, DLF, Blue Star, Vesuvius. The list is pretty long, so let's take a look at it. Stocks with positive news flow. There's Marico, TVS, TVS Motor, GMR Airports, DLF, SRF, Blue Star, Spandana Sphoorty and Vesuvius. While stocks with negative news flow, there's UPL and Butterfly Gandhimathi. But what's another positive trigger for the market is that Brent has cooled off. Brent crude has cooled off a little bit. There's no de-escalation just yet. There's no ceasefire just yet as far as the Israel-Hamas war goes. But Brent has come off a tad bit, perhaps in anticipation of that. Manisha Gupta is joining in with a quick roundup of all the action that took place overnight. Manisha, good morning.
Morning, Sonia. Thank you for that. Well, absolutely. The crude oil prices fell 3% overnight, and WTI fell almost 4% at one point in time as well. While it has been about some profit taking on the higher side, we haven't seen crude oil supplies being impacted with the conflict in West Asia, and that took the premium off Also in the morning today, the Chinese manufacturing numbers as well as the services growth, both those numbers came in on the weaker side. That's weighing on as well. The 0.5% increase that you are seeing on your screens right now comes in after the World Bank suggesting that if the conflict continues to escalate in the next year, then the crude oil prices in a worst case scenario could rise as high as $157 as well. So there are all those numbers floating around, and that led to some opportunity buying coming back in case of crude oil prices.
All right. Manisha, thank you very much for that. And we'll keep coming back to you to get the latest on commodities, oil specifically. But for now, oil is well behaved. It's down from that 90-ish kind of levels. We'll take a quick commercial break here. We'll come back. Our first guest on the program on markets will be here. Siddharth Khemka of Motilal Oswal Financial Services will weigh in on stocks. Lots of earnings to react to. We'll also have the first management join us in just a bit from now. Sandeep Sangwan of Castrol India to talk about their quarterly performance. Stay tuned.